Daily chart, we finally reached that magnet of the November 2025 low. That was a logical support location for the market to test. It was reasonable for the market to test down here, find buyers. And I still think the odds are there's buyers down here. What are the chances we break to the downside? We can certainly break to the downside. But I think the reality is, the real question is, what are the chances that we're going to get a measured move down of this range? If you think about, here's the range, here's the high, maybe it's up here a little bit higher, here's the lows, November low. What's the chance we're going to fall all the way down to 62.15? Well, right now, let's say the all-time high is, we'll just say, keep it really simple, say it's 7,100. So if the market's at 7,100, then a 20% correction would be 5,600. So a 15% correction would be about 6,000. I think that's the problem overall. At any time, obviously, 10% correction is right around 63.90. If I'm doing my math right. And I think the challenge overall is, if the market sells off to right around here, traders will start to find that as an attractive location to buy, and investors will start buying, people will start buying. That's also right around these breakout points over here. I think the downside risk is fairly small. Obviously something crazy could happen, but I don't think that anything. I think the reality is, and there's probably buyers below. The market probably, there we go. The market likely wants to, I suspect the market's going to test back to the 6,900, basically the midpoint of this trading range. And ultimately, I suspect the market will test back to 7,000 and the all-time high. That's because of the higher time frames have been fairly bullish for some time. 60-minute chart. We've been in a broad channel for a while. And you can see this broad channel. I'm going to remove. I think that's less important. This broad channel is contracting and sloped down. So it's basically a wedge. 1, 2, 3 pushes. Not a great shape. You can also draw the wedge right here. But the point is, you're breaking out to the bottom of the channel, and now we're starting to stall and find buyers. And that makes me think there's an increased risk that we're probably going to get some kind of reversal up and eventually test of 6,800 in the most recent major lower high. 5-minute chart. 5-minute chart, we had this really pretty strong sell-off yesterday, and it was enough selling pressure that it was a strong enough breakout. It increased the odds. And I forgot to mention this. I wrote it in the blog, but I'll just say it real quick. I thought yesterday, closing on its low, that was a strong enough downside breakout that the odds were we'd probably test the November 2025 low. And we got the reversal up. We tried several times. We got the reversal up here, and both of those times, I thought the odds were fairly high that the market was probably, or that the problem for the bulls was the market was likely going to require a test of November of the support level. When the market's in a trading range, it's really common for the market to probe beyond support and resistance. If you have an obvious higher low right here, it's common for the market to fall below it. And what's also common is as the market starts to test down, it gets near that support level and then ends up finding buyers reversing up and then ultimately having to reverse back down. So when today gapped down on the open, I thought it was a strong enough Let's probably good enough. When today gapped down on the open, I thought there's a 75% chance we'd probably form a trading range lasting 2 hours before the end of the second hour. And that's because when you have a sell climax late in the day, it's pretty common for the market to form some sort of trading range on the open. I also thought the odds were pretty high that the market was likely going to test I thought it was pretty high that the market was probably going to test back to yesterday's low at some point in the day. And that's because the market was at that support, the November 2025 low, so this red line. Bar 2, we formed an inside bar to doji, and not a great sell below the bar. It's not a great buy either, but probably at support on higher time frames, you will have bulls buying and scaling in lower, and that increases the odds that we're a lot closer to support than resistance, but we could easily get a second leg down and fall below 1 first. And then 4, we had consecutive bull bars, 3 and 4. That increased the probability that the market was going to go higher. And therefore, probably okay to buy the close of 4. And you can see traders, when 3 closed, they bought the bottom third of 3 and the breakout point too high. 5, another bull bar. That's good for the bulls. Increases the probability that we're going to go at least a little bit higher. But when you're getting near the 81 close and the moving average, and the channel down's fairly tight and parabolic, or climactic, which is the same thing as parabolic, that increases the odds that I don't know if we're going to get a measure move up based on this opening range before we pull back. And that makes me think the reality is there might be more traders looking to buy a pullback, but the first reversal down is probably going to be minor. Because of the tail on 4, the market went down after bar 3. Now we have a big bull bar. Now we have a bigger bar on bar 5, and there's not a lot of overlap compared to 4. So that increases the chances that instead of buying the close of 5, you'll have traders buying a pullback of bar 5. And that's what happened on bar 6. 6 high 1 buy. Good for the bulls, increases the odds. It's a high 1, so we may get a pullback, but we'll probably get some kind of second leg up. So while there might initially be sellers above the high of 6, there's probably buyers near the bottom third of 6. And then 7, we broke out above 6 and we pulled back on 7. Stop order sell, not a great sell because of the tight bull channel up to bar 5 in the breakout. With 3 consecutive bull bars, 3, 4, and 5, likely to get some kind of second leg up. And then bar 8, we have a doji, not a great buy below the bar, not a great sell below the bar, because it's probably going to have to go more sideways. But it's also not a great buy above the 7 high either. So I suspect we'll probably be sideways here. And then 9, we have a doji. The market broke to the upside, found sellers. Give me just 1 second here. 9, like I said, we had a doji, but several pushes up and getting near the moving average. Low probability sell below, but there's increased risk that we may end up testing lower. And then something interesting happened with bar 10. Come on. There we go. 10, we broke to the downside. It's not a great looking entry bar after 9, but because 10 it's a bear breakout below 9, you have limit order bulls that are trapped. Some bulls bought below 9 and they got trapped with 10. Plus 10 is also a weak high 1 buy. And because of that, you'll have some traders exit in the upper third of bar 10 during 11. And you can see what happened. When 11 tests back to the 9 low, a lot of bulls sold out of their longs and bears sold to go short. And that's what led to a small second leg down on bar 11. 11, bear bar, good for the bears. May go a little bit lower, but near support, the 2 high. Probably not going a lot lower. And then 12, now we have another bear bar closing on its low. 12 is actually a bar I made a mistake on. I bought a pullback during 12, thinking we would test back down at a low of 1. That was a dumb trade because obviously you're at support. There's probably buyers down here. And then 13, obviously, if you're a bear on 13, and you see the market start to reverse up quickly, you got to be pretty quick to buy back your shorts. And a lot of traders did that, and plenty of traders, when they see it start to reverse up, they just buy. They just hit buy, they just reverse their position. 13, bull bar, but a relatively big bull bar with big risk. And you don't know what the follow through is. And that lowers the probability for the bulls buying the close of 13. And then 14, we have a bear reversal bar closing on its low. That's good for the bears. But do you really want to sell below 14 after you see a bar like 13? Probably not. For me, 13 is a strong enough bar that will probably get some kind of second leg up, and therefore buying below 14 is really not ideal. There's probably more buyers down there than sellers. But 13 is a strong enough bear bar that if you bought the close at 13, you're probably disappointed on 14. I said 13 is a big enough bar, and disappointment for the bulls who bought. Let me just back up. I'm saying the wrong bar numbers. 13 is a big bar, and it's likely to get a second leg. But 14 is a big enough bear bar that bulls who bought the close at 13 are likely disappointed, and they'll use the reversal up to exit. And then 15, we had a doji. That's a strong enough doji bar. We had a doji, and because 14 is strong enough to get a second leg down, and the first reversal up was likely to be minor, you can see bulls who bought the close at 13 getting out break even during 15. 15, not a good sell. It's an implied second leg down below 14, and that's why there were buyers below. And then 16, we have a bull bar, but right below the moving average. Not a great buy signal bar for the bulls. Increases the odds that we may end up going more sideways here, so really not ideal. And then 17, doji. Disappointment for 17. It's a doji bar. It's disappointing for the bulls. Some bulls who bought 16 will be disappointed 17, get out break even on the next bar. But you can see it on 18. Not a great sell below 18. And I still think, odds may slightly favor the bulls, but again, not ideal. 19, bull bar closing on its high. This is good for the bulls. If the bulls are going to get an upside breakout here, I think 19 is a good candidate. And then 20, that was disappointing. The bulls broke to the upside on 20 and the market reversed down. So that is a disappointment bar and increases the odds that the market may end up finding sellers. It's a disappointment bar for the bulls. So that increases the odds that you have trapped bulls and will probably find sellers not far above. So some bulls, they bought during 20, and as the market pulled back, what are they going to do on a retest of during 21 or 22? They're probably going to look to sell. Then we have bull bar closing on its high 21, but trading range day, possible second failed breakout above the 9 high, near resistance, the yesterday's 81 low. That increases the chances that we may get a pullback here. Plus, it's 2 legs up, rally, pause, second leg. And it's a larger second leg up with the opening rally. The rally up to bar 5 or the bar 9, pullback, second leg up, bar 20. Now look at this leg 1, leg 2. Why did I take a leg 1 from the one low to the 5 high and project it down to 12? Why not? Why did I not do this? The 1 low to the 9 high and project it down to 12, which it didn't reach. The reason why I chose bar 5 initially right there is because that was the breakout. I thought that was the initial leg. The low of 1 to the high of 5 was the first leg up, and 6, 7, 8, and 9, that was sideways trading. 9 is a smaller leg. It's a smaller second leg that it's pretty common for the market to rally, pause, and then get a small initial second leg up, lasting a few bars, and then get a deeper pullback. But the point is, 21 is already late in a second leg up, and typically that increases the risk when the market's in a trading range that we may go sideways here. And then 22, we had a little bit of a surprise that increased the probability that the market was going to go lower. So 22, that is not a good. That's a problem for the bulls who bought below 21 and increased the chance we're going to go lower. 23 consecutive bear bars. Good for the bears. Probably going to go at least a little bit lower. And then 24, bull bar. That's not a good bar for the bulls. Increases the odds that we'll probably get some kind of second leg down. So I suspect there's probably more sellers above 24 than buyers. And then 25, we have a bear bar, but not a strong bar for the bears. Increases the odds that we're probably, 25, it's a bear bar, but it's a second leg down after 22 and 23. And that makes me think there's an increased probability that we're probably not going a lot lower. In other words, 26 might be a disappointment bar. And then 26, we can see, obviously disappointing bar for the bears who sold the close of 25. So some bears who sold 25 might be disappointed 26 and buy back their shorts on the very next bar. 27, bear bar, but not ideal. It's a low one short, and that increases the odds that we may end up finding, that increases the odds that we may end up getting a pullback. But even if we do, I suspect there's sellers probably not that far above, and we'll probably test back to the 27 low in the range, so it's getting dangerous for the bears. 28 bull bar, but possible double top with 26, so not really all that ideal. And then 29 bear bar closing on its low. That's a second entry. Not a great second entry. Tight trading range, and you can see the low one's 27 and the low two, 28. 29 is the low two in the second entry. And you can see it's allowing bears to sell at a better price than the low one at 27, and it's in the middle. It's basically a tight trading range, so it's basically the same price structure. That's really not ideal. And that's why it led to a trap, and 30 is a strong bull reversal bar. You can see what happened. There were so many traders buying the close of 29, preventing it from triggering, that 30 quickly reversed up. 30 strong enough bar, probably going to get a second leg up, and we may end up testing the 21 high. But then 32 hit 31. The market sold off, forming a tail, and then rallied. So it's a trend line break with 30. The market rallied, broke the trend line, rallied again on 31. That increases the chances that there might be sellers not far above. And then 32, the market rallied above the 31 high and ended up pausing. Strong enough rally that we'll probably get a second leg up, but because of the tails 31, 32, odds are we'll probably get a pullback. 33, bear bar. Not a great bar for the bears, but it's a strong enough bar that we may end up getting a small second leg down. So the first reversal up might be minor. And then 34, pause, but not a great 34 follow through after 33. But middle of a tight trading range, really not that great of a sell, so we may get the reversal up. 35, doji, not a great buy, not a great sell, but also not a great buy either. But I suspect that we'll probably try and test up to the 21 high, and the bulls who bought above 30 will probably try and get a second leg up. 36 bull bar, but a 4-bar bear micro channel from 32 to 35. Probably sellers above, and we may go sideways here. 37 bear bar, but not a great sell for the bears, probably buyers below. And then you can see what happened. We broke below 37 during 38, and we reversed up, forming a bull bar. For the bulls, we have a decent buy signal bar. It's not a great buy signal bar. It's a relatively small bar compared to the bars to the left. And you can see it's a very small body relative to a tail, so it's actually more bearish than bullish. But because it's a bull bar closing above the moving average in an implied second entry, it's not the world's worst stop, hold, or buy. But you have to understand the expectation behind the bar. Odds are something disappointing. And when 39 broke above 38, rallied, and then started to pull back on 39, a lot of traders would be fairly quick to exit. 40, bear breakout. Enough of a surprise that I thought the bulls who bought above 38, they were disappointed with 39. And I thought the disappointment I thought the bear reversal on 30 on 40 was strong enough that the odds favored some kind of second leg down. 41 consecutive bear bars, 40, 41, strong enough bear reversal that we'll probably get some kind of second leg down and maybe test all the way down to the one low. And then bull bar 42, but that's not a great buy for the bulls. Increase the odds of sellers above and a second leg down. 43 outside down, good for the bears, probably going to go a little bit lower. And then 44, follow through for the bears. That increases the odds that we may get another leg down. But now we have consecutive, we have 2 legs down already. 40 and 41, that's the first leg, pause 42. So that's leg 1, pause, leg 2. And then we have a larger leg 1, pullback, pause, leg 2. And therefore, selling 43, 44 is actually quite dangerous. 45, doji, that's not great for the bears, and that increases the chances that traders will look to buy back their shorts. And that's what happened with 46. 46 bull bar, good for the bulls. Probably going to get a second leg up. But the risk the bulls face is that the channel down to 45 is tight, and therefore the bulls may have to sit through a deep pullback. Follow through 47, not a great follow through bar. And because of that, when 48 formed the doji, you had some bulls who bought 47, disappointed 48, getting out break even below the bar, or break even after. You have some bulls who bought 47, disappointed 48, getting out break even back at the close of 47 during 49. Other bears and bulls sold the upper third of 48, betting there was a weak high one by 40, hit 49. Decent bar for the bears, increased the odds we get a small second leg down, which we got on bar 50. Bear bar closing on its low, testing the breakout point 45. Is that strong enough consecutive bear bars that we'll get a second leg? It's possible, but there's one important thing to understand, and this might be a good homework lesson for some people in here. Look at a 1 minute chart of 48, 49, and 50. And what you'll see is that 49, you could argue this is basically a second leg trap. The market sold off the high of 47 to the low of 48, had a deep pullback, the high of 49, and then a climactic second leg, the high of 49 to the low of 50. And that increases the odds that this might be just a sell vacuum test of support. 51, bull bar, good for the bulls, but a micro channel from the high of 47 to the low of 51, increasing the odds. The first slip is going to be minor. And then 52, consecutive bear bars, 51, 52, increasing the odds that that the first slip is probably going to get bought. Or let me say it differently, in consecutive bull bars, 51, 52, that increases the odds that there might be traders buying here, betting on a second leg up above 47. Bull bar, 53, that's good for the bulls, but a fairly climactic bar, fairly large, middle of a trading range, that actually makes it dangerous for the bulls to buy. And you can see they got trapped on 54. 54 closing on its low. Strong enough bar. I think it's okay for bulls to get out below the bar, even though 54 is closing above the moving average. And after 3 consecutive bear bars, there's probably buyers at the 54 low and near the 52 high. It's still dangerous. And then 55 consecutive bear bars, but testing the bottom of the buy climax, the 53 low. There might be more traders buying down there than selling, but really not high probability. Doing anything in here is actually quite difficult because probability is so close to 50-50 and risk reward is not great. So if you're going to do anything, you're better off selling below 54, stop above 53, and going for twice your risk. Or if you're going to buy, you're better off buying 51 or 52, stop below the bar, and going for twice your risk. Basically, you're reducing your risk and going for a breakout up or down. 57, bull bar, closing near its high, but tail above the bar, and possible wedge. We talked about that several times. The traders buying, it's actually a fairly dangerous trade for traders to buy. And then 58, bear bar, not a great sell below, but not a great buy above, increasing the odds that we may end up pulling back here. You have disappointed bulls who bought 57, disappointed 58. Some of them will look to get out break even back to the close of 57. And you can see what happened on 59. 59, we have a bear bar closing near its low, consecutive bear bars. Possible wedge top, that increases the odds that we may go a little bit lower. And then 60, bear bar, strong enough bar closing on its low that we may get some kind of second leg down. And then 61, we have a bull bar, or we have a doji, not a great sell. 61, we have a doji, not a great buy for the bulls after the consecutive bear bars, increasing the odds of sellers above in a second leg down. Second leg down, 62. I suspect that let me say it differently, second leg down 62, but an outside bar at support, 55 low, makes me think there's probably more buyers down here rather than sellers. And the bears try to get vol through 63, but again, too much risk. It's a second leg trap. And you're in the bottom third of the tight trading range when the bulls got the bull bar 64. A lot of those traders were disappointed. And we talked about that here. They got out, break even back at the 63 close, and they bought back their shorts at the low of bar. They got out of shorts below the low 164 and bulls bought, and then outside up 65. It's probably a strong enough bar that it's probably okay to buy, betting, taking a chance we get the reversal. And obviously, if you bought above that bar, you're pretty happy. And then we got the surprise breakout up here. But as I talked about it, 66 probably an okay buy the closed bar if you're quick to make decisions. But then once you get 67, it's becoming pretty dangerous for the bulls to buy. Why is it becoming dangerous? Because the risk reward is not ideal. If you're going to buy 67 and put a stop all the way down here, 66, and you're risking more than 30 points, and the odds are probably against you that you're going to make 30 points in the next 10 bars or so. So it's really not that great of a trade. You have time running against you, and that increases the risk that we may get a deep pullback, contested breakout points. Plus, we had so much trading range price action overall that it's really not ideal. And then when we had the inside bar 69.70, I thought it was reasonable to get out of longs, especially below a bear bar 71. And then bulls, I mentioned some bulls will buy down here, but when the market started to go sideways, a lot of those bulls would just get out. For stop orders, probably buy above 3, buy above 4, probably okay. Even buying above 5 or buying the close of 5 is probably okay. But you're probably going to be quick to get out somewhere around here, break even. You can sell below 9 if you're aggressive. And then, if you're still short on 12, what do you do with 13? You probably get out a couple of points above 12. I think it makes a lot of sense too. So anyways, as I was saying, you probably have to get out, a couple of points above the 12 high. So it's really not ideal for traders to be, forget what I'm saying here. If you're short on 12, it's not ideal. And if you are, you got to get out a couple of points above 12, certainly as 13's breaking out. And then, maybe okay buy 16, stop below 16, taking a chance we break to the upside. Same thing with 19. And then if you're long, you definitely get out below 22. And then I think bears probably get out maybe above 28, or they get out on the reversal up on 30. And then if you're long, I think it's okay to get out below 33. I don't think you have to. And then 40, I would definitely get out. Triangle, decent bear breakout. The bulls had a chance to buy above 48, which is probably okay. Bulls get out below 40, bears sell. And then I think bears get out as 46 reverses up. If they're still short, bulls they can buy 46. Some may get out below 49. And then if they do, they probably buy again above 51 or 52. It's the opposite for the bears. If bears short 49, they get out above 51 or 52. And then bulls that are long, they get out below 54. And then bears, if they sell, it's not ideal, but I think bears have to get out of shorts above 56. And then bulls, maybe they buy 56. I still think it's kind of tough. And then up here, anyone that's long, I think they definitely get out of longs below 59, or during 60. Bears can sell, and then they get a second leg down. Bears definitely get out of shorts above 62 or 60. Bears get out of shorts above 64, definitely 65. Bulls can buy. And bulls get out of shorts probably below any bar. Certainly below 73 at that point. That's probably it for stop orders. Limit orders, I thought buyers in the bottom third of 3 made a lot of sense. I thought maybe sellers above 6, but I'd rather look to buy some sort of a pullback at that point. And I thought probably buyers below 15, and I thought probably sellers above 42, buyers below 48, scaling in lower, and probably buyers below any of these bars down here. Certainly buyers below 64 for the bounce. And I thought buyers after 72, buyers in the bottom third of 72. But when the market went sideways, better to get out. Buy the close, sell the close. Maybe buy the close on 3, probably better 4, but difficult once you get to bar 5. You're so close to the moving average, may not go a lot higher. And then for most of the day, it was opposite. You see a big bear bar or a series of bear bars, you buy it. See a big bull bar, you sell it. And you see consecutive bear bars, 60, 22, 23, probably okay for a sell, betting on a second leg down. And other than that, maybe buy the close 66, maybe 67, but I think that's pushing it by a lot. So really not ideal. Let me take a look at questions. The question, what would you recommend someone who's too quick to take profits? I've done it several times today, where the volatility has given me a bigger than usual profit quickly. But I know that from the chart, it should move further. But as soon as it pauses, I close the trade. Well, I think there's a few things. One, hindsight is 20/20, and when you look at a static chart printed at the end of the day, it's always a lot easier and more clear than when it is real time. So on one hand, I think you have to ask yourself a few things. One, let me go back to your question. You're asking, what would you recommend someone do if they're too quick to exit? Well, I think you have to look at it 2 different ways. Are you quick to exit when the market's in a trading range? Or are you quick to exit when the market is strongly trending? On a day like today, I'm generally very quick to exit. And, that causes me to miss out on certain moves. For example, I bought somewhere in 66, got out at the high of 24. So I made a very small portion relative to the entire move all the way up here, and that's okay. But for me, my logic for getting out quickly was that the market's in a trading range, and it's probably not going to go all that far. And that's okay. That's typical trading range price action. Now, normally I would say a way to think about how to work on that is trading always in. For example, you start looking at stop orders and you swing trade. But swing trading, when the market looks like this, is a terrible idea. I think it's really difficult. So even when I take stop orders on a day like today, I'm generally going to be pretty quick to exit the trade. And that's because my expectation is the market's going to reverse below bull bars. But if we're going to look at a different day, something like this. If you're going to trade always in, let's say you buy above a bull bar or you buy after a series of bull bars, one way to trade is to exit below bear bar. So you're long, you put a stop down here, and you stay long, and then you exit below a bear bar here. Or because the channel is such a tight channel, maybe you exit after a series, 15, 20 bars sideways. Same thing here. You sell below 7 consecutive bear bars, probably sellers on the first reversal up, and you just stay short until you get a bull bar closing on its high, and then you exit. If you sell below the 19 low, you stay short, and then you exit above a bull bar, or maybe a series of bull bars down here. If you sell below 32, you just keep your stop above the bar, and you tighten your stop, and you exit above a bull bar. This bar didn't trigger. Maybe you get out there, but knowing parabolic wedge first reversal up is probably going to be minor. Other than that, I think it just takes a long, long time. And I've seen a lot of trading range price action days. And I've seen a lot of trading range days where you get some sort of crazy breakout at the end of the day. And it just doesn't bother me. I never worry about, taking something and missing, a chunk of the move. It's just if you're going to trade, that's a fact of reality. And it's kind of like, I think about it in the same context of, I just know I'm going to be disappointed about something every day. And that's okay. You live with it, and you just move on to the next trade, and just don't let it bother you. Other than that, I think just the more you learn about price action, it becomes easier through time. Someone asked about the highlighted bars. The close of every bar is highlighted in red. And that's just the close of every hour is highlighted in red as a reminder that the hourly bar is closing. 18 bar is blue because of the 18 bar range. So I'm not seeing any other questions. So I'm going to go ahead and wrap this up. But overall, tomorrow it'll be interesting. We have a bull reversal. So it'll be interesting to see what kind of follow through we can get tomorrow with the bull bar, with it being a decent bull bar. It'll be interesting to see, can we get strong follow through tomorrow, or will we get something disappointing? Even if we get something disappointing with tomorrow, I suspect there's buyers probably below it. The odds of the market getting, that impressive of a sell or stop order sell, I think it's pretty low probability here. So we're probably going to get some kind of a bounce and test up to the high of this bar, the March 17th high. Okay. Thanks everyone for listening today, and I hope everyone has a great rest of their day. Thank you.